This is Business Incorporated coming to you live from Lagos, Nigeria. Thank you for joining us. I'm Chimeze Obi Wago. On the program today, oil prices rise more than 1%, but most major markets are closed to mark the Eid al-Fitr celebration. The International Monetary Fund set to visit Mozambique to discuss debt audit concerns. Plus, South Africa's Simbaye Gold says its coke operations would remain closed today, almost 3 weeks after workers downed tools in a wildcat strike. Let's get started now, of course, starting with the market. Most global markets are closed today to mark the Muslim Eid al-Fitr celebrations. Here in Africa, only the market in South Africa is trading. However, on Friday, the Nigerian equities market closed 2.45% down, all thanks to the losses recorded by the two industrial giants listed on the industrial and consumer goods sectors, that's Dangote Cement and Nigerian breweries. The market, of course, remains closed till Wednesday. Now, the market in Egypt started its holiday on Thursday, but closed that day positive, up 0.30%, and Nairobi was up 0.16% on Friday. Markets in the Middle East are on holidays to mark the Eid al-Fitr celebration. However, Saudi Arabia's stock market extended on the previous session's rally on Thursday as investors focused on shares likely to benefit from economic reforms and from MSCI's decision, while Qatar rebounded as foreign funds were net buyers. Saudi was up 1.24%. Qatar stock index rebounded 2.88%, snapping 4 sessions of declines as 39 shares rose and only 2 declined. Elsewhere, Abu Dhabi's index fell 0.62% as Eshrak Properties, the most traded stock, lost 8.7%. Dubai's index fell 0.47% as shares of the most traded stock, GFH Financial Group, slumped 8.9%. In Europe, bourses there moved higher during early morning deals as banks rallied on the news that Italy had reached a deal to wind up 2 ailing regional banks. Let's bring in Conrad Busse now, my colleague in Frankfurt, to tell us how the market has fared so far in today's trading. Hello, Conrad. It's good to have you back on the show. You are not on holiday, just like me.
Yes, I just came back from a short holiday. It's great to be back on Channels TV. Hi, Jimmy.
Oh, yeah, I know. You were off for 1 week. Welcome back from your vacation anyway. Now, Italy started winding up 2 failed regional banks on Sunday in a deal that could cost the state up to 17 billion euros. Is this a piece of significant news for the European markets?
It is indeed, Jimmy. The problems of those 2 banks were or have been a matter of discussion for quite a while now. They were sitting on way too much bad debt, and there was nobody out there really to help them out with fresh capital. So the question now was, would there be a bailout with or without the contribution of the Italian taxpayer? And in this case, the Italian government decided, in accordance with the authorities of the European Union, that for once, in this case, it would be okay that the Italian government steps in with taxpayers' money, something which is, of course, not according to the rules of the European Banking Union, which wants to make sure that never again, a bank is bailed out by taxpayers. But in this case, the problem is that many of the bondholders of those banks are mom-and-pop investors, ordinary Italians, that were sold those bonds as a savings instrument. So if, the strict rules of the banking union had been applied here, it would mean that it would have meant that those investors lost all their savings, and that was not politically viable in Italy. That's the reason why, again, the taxpayers in Italy have to bail out these banks. For the other banks in Europe, of course, this means the concentration process in the sector continues. Banks who are strong and fit enough, who have enough capital in order to work profitably, even profit from this concentration process. And that's one reason why the shares of the European banks all are in great demand today.
Well, it seems, of course, some lose, some win in this case. Anyway, activist investor Daniel Loeb's Third Point, that's LLC, has unveiled a more than 1% stake worth some 3.28 billion Swiss francs in Nestle. Is the food giant desperate for this cash, or what else does Nestle want?
Well, Nestlé itself doesn't really talk very much about this. It came out with a statement that says, we keep an open dialogue with all our shareholders and we remain committed to executing our strategy and creating long-term shareholder value. End of quote. But if you ask me, it's quite imaginable that the executives of Nestlé would rather have this new investor go as quickly as he showed up. Loeb and his hedge fund, this is really an active investor which ruthlessly pushes for higher profit margins. In the case of Nestlé, Loeb also wants that the company sell its large stake it's holding in the French company L'Oréal in order to be able to finance share buybacks. Loeb also wants Nestlé to take on more debt in order to finance share buybacks. This would be completely the contrary of the traditional strategy of Nestlé, which has a reputation of growing rather slowly but sustainably. A sustainable flow of profits, that was what Nestlé wants. The Loeb idea comes along with rather short-term profit goals, less investment in research and development, more cost-cutting, something that is not in the tradition of Nestlé. Of course, whether or not he will be successful with this push remains to be seen. He bought shares of more than 3 billion euros of Nestlé. Sounds like a lot, but it's only 1.3% of the total of the shares. So in order to really get through with his ideas, Loeb would have to buy more shares or find allies in order to get majorities at a general shareholder meeting.